Hello everyone, welcome to the inaugural series of trading videos showcasing smart money techniques. In today's episode, we will focus on identifying crucial supply and demand zones to determine optimal entry and exit points for trading. If you find value in this video, please show your support by liking and subscribing. First, let's talk about supply and demand. Buyers and sellers are always competing to set prices. When the power of buyers or sellers goes up, it starts a trend. Either prices go up or down. In a bullish trend, the price consistently continues to rise, forming new ceilings and floors. As long as the price fluctuates between these two boundaries, the ceilings represent supply zones, and the floors represent demand zones. However, with the growth in price and the establishment of new ceilings, the previous ceiling transforms into a new demand zone. In a bullish trend, floors always hold greater significance compared to ceilings. Due to the presence of more buying orders at the floors, there is a consistent possibility of breaking the ceiling and experiencing a reversal from the floor. The bearish trend is exactly the opposite of this. In this case, it's the ceilings that hold greater importance compared to the floors. Supply and demand zones can occur as single candle or multi-candle formations. The common factor among all of them is that when the price reaches these areas, the direction of the price rapidly changes due to the presence of significant buying orders in uptrends and selling orders in downtrends. But the important point is that the price does not react to all supply and demand zones, and many of them fail. The crucial issue is which of these zones has more significance, and is it possible for the price to reverse upon reaching these areas? The sharper the price movement when it approaches a supply or demand zone, the more significance it holds compared to an area that has been moving over a longer period of time. The significance of a supply or demand zone is often greater if it has taken less time to form compared to a zone with a longer formation period. By examining the differences in the formation of bullish and bearish candlestick patterns at tops and bottoms, it becomes evident that top patterns initiate moves in a shorter period than bottom patterns. Less time is spent forming the supply and demand zone in top patterns, making these zones more significant compared to bottom patterns. For instance, consider a bearish movement that, by creating ceilings and continuing its trajectory, forms two supply zones. Upon reaching the first supply zone, the price reacts, but as the zone breaks down and encounters a higher zone, the main trend begins. In strong upward or downward movements, where there is no opportunity to establish a floor or ceiling, single candles are considered as supply or demand zones. The significance of the last single candle formed is always greater. However, if this area is breached, the price usually declines to the previous floor or ceiling and then continues its own movement. The next pattern is one of the important ones that you should always consider in your trades. Whenever, after a significant supply or demand zone, a support and resistance zone is formed, in most cases, this zone faces a break, and the price, after encountering the supply or demand zone, continues its own path again. But let's see how this pattern works. Initially, with the breakthrough of the resistance area, buy orders are placed, and their stop losses are typically located within the support area. Then, as the price retraces and passes through this area, both the buyers' stop losses and sellers' orders are triggered simultaneously. However, as the price reaches the demand area, it begins to move in a way that results in the breaking of both buy and sell orders. The zone that is newly formed and less tested always holds greater significance compared to an area that has been touched by the price several times. Additionally, a zone where the price has reached multiple times without showing a significant reaction is not considered a supply or demand zone. And ultimately, the most important point in trading using the smart money technique is the identification of supply and demand areas across different time frames. For example, consider a downtrend in the higher time frame. As the trend persists and prices decline, several supply zones form, and the price reacts upon reaching these zones. What needs to be emphasized is that, in lower time frames, as the trend continues, more support and resistance levels are formed, and many supply and demand areas experience breakouts. Therefore, the supply or demand zone formed in higher time frames holds greater significance compared to the supply and demand areas in lower time frames. Of course, in the upcoming sessions, we will delve into the topic of entering the market in different time frames in detail. The final point is that identifying significant supply and demand zones is not a confirmation for entering a trade. Although the price often reacts upon reaching an important zone, in most cases, these zones face a breakdown. Identifying these zones guides you to the right entry point, but entering a low-risk trade requires additional confirmations, which we will discuss in the upcoming sections. If this video has been helpful to you, don't forget to like and subscribe.